the most important thing is the fundamentals have never been better. Not only do the charts look great for gold, but the fundamentals are fantastic because we're in a situation where we have inflation that has just bottomed at about 3%, is now headed higher, and there's nothing the Fed can do about it. It is out of ammo. It can't fight. There is no way the Fed is going to hike rates.
In this insightful analysis, Peter Schiff delves into the current data, providing a compelling case for the bullish trajectory of gold. With recent inflation figures surpassing expectations and import-export prices experiencing significant spikes, signs indicate a bottoming and subsequent rise in inflation. Despite the distractions posed by Bitcoin's rally, Schiff underscores the enduring resilience of gold and its unparalleled status as the ultimate safe haven in times of economic uncertainty. He urges us not to overlook this opportune moment, highlighting the minimal downside risk and the substantial upside potential that gold presents. Let's continue with the interview.
What inflation means is that the dollar is losing purchasing power. And so if the dollar is losing purchasing power faster than you thought, why would that incentivize you to want to buy the dollar? It's a reason to want to get rid of your dollars. But again, it's the anticipation of higher interest rates that is driving this trade. But the reality is rates aren't going up anymore. In fact, they're going to come down. Even if the Fed delays the official rate cuts, real interest rates are falling. Because if rates stay where they are, but inflation goes up, which is what it's doing, that means real interest rates are falling. And real interest rates are far more important for the price of gold than nominal. But looking at the PPI numbers, and this was even worse than the CPI, and the PPI is a leading indicator of the CPI because generally producer prices rise first and then consumer prices rise later. And so this is more indicative of higher future CPI numbers than the CPI itself. And the monthly number was supposed to be up by 0.1. Instead, it was up by 0.3. The core number was supposed to be up 0.1, and instead it rose by 0.5. That is a big number. In fact, the beat in core month-over-month CPI, this is the biggest beat, meaning the most the core rose above what it was expected to rise. This is the biggest beat in 3 years. Now, that doesn't sound like a Fed that has succeeded in putting the inflation genie back in the bottle when the numbers are coming out so much hotter than expected. In fact, getting back to the consumer price number that we got on Tuesday, if you annualize the increase in the core in the month of January, it annualized out to 5%. I mean, that's more than double the 2% that the Fed is, in theory, targeting. Actually, this week we had a trifecta of worse than expected inflation news. We got import-export prices that came out yesterday. Now, not too many people even follow import-export prices. They talk about the CPI, they talk about the PPI, but these numbers are highly manipulated by the government. I like the import-export prices better because they're not adjusted. They are what they are. There's no hedonics. There's no substitution. And the expectations for January import prices was a drop of 0.1%. And the expectation for export prices was a drop of 0.2%. But what happened was both import and export prices spiked by 0.8%. That is a huge move in 1 month. And to me, it's another indicator that inflation has bottomed. In fact, import-export prices are more of a forward-looking number, especially the import prices, because those are ultimately going to be put into final goods because the importers are generally the businesses, and they turn around and resell. And so these higher import prices are going to be reflected in higher retail sales prices in the months ahead. So this is more news that the markets are ignoring, that inflation is not bottomed. And in fact, the idea that we're going to continue to drift lower down to 2% is absurd. Inflation is far more likely to rise back to 9% than it is to go back down to 2%. So the markets still don't get this. The Fed, for whatever reason, still maintains its credibility. But I think the fact that the price of gold recovered quickly and managed not only to close positive on the day, but positive on the week and back above 2,000, even though we had all these higher than expected inflation numbers that have pushed back the expectation of when the Fed is going to start cutting rates. I think that's a very strong sign in the gold market. Of course, there was weakness again in gold mining stocks. They finished down on the week. They really got clobbered on Tuesday when gold went down because there's so much fear in the gold stock market. And I think that is a very strong contrarian indicator that we're at the bottom when so many people are fearful. In fact, Barrick Gold this week, which is one of the bellwether stocks, made a 52-week low on the week. Even though gold barely went below 2,000, you're talking about a major mining company where sentiment is so negative that it traded at a 52-week low. And I think another contrarian indicator on the week had to do with the rally in all these new Bitcoin ETFs, which rallied big and made new highs. And I saw a lot of people posting charts that showed huge outflows of the gold ETF, GLD, and big inflows into the Bitcoin ETFs. And they're trying to say that, see, everybody is moving out of gold ETFs into Bitcoin ETFs. Now, I doubt much of the money that went out of the gold ETFs actually went into these Bitcoin ETFs. I think a lot of these gold investors are throwing in the towel. It doesn't mean they're necessarily buying Bitcoin just because they're selling their gold, but I think the Bitcoin pumpers are trying to pretend that this is what's going on, although it certainly is possible that some of the money that went out of gold ETFs went into Bitcoin ETFs. My guess is most of it just went into money market or maybe into the stock market, but not into these ETFs. But I think the fact that you got this big rally, and I think the catalyst for the rise in the Bitcoin ETFs, first of all, they all dumped about 20% immediately after they were first launched. But there was a big ETF conference down in Miami this week, and Bitcoin is notorious for pump and dumps around these type of events. So I'm sure there was a lot of hype, a lot of pomp and circumstance about the Bitcoin ETFs. I mean, they were probably the talk of the conference, and so that probably caused a lot of people to buy and pump up the price. So my guess would be next week we'll see the dump following this week's pump. But I think where the action is going to be is in gold. Well, everybody was sidetracked by what was going on in Bitcoin. They overlooked what's going on in gold. Everybody is writing gold's obituary. It's not dead. It's alive and well. It's over 2,000. But the most important thing is the fundamentals have never been better. Not only do the charts look great for gold, but the fundamentals are fantastic because we're in a situation where we have inflation that has just bottomed at about 3%, is now headed higher, and there's nothing the Fed can do about it. It is out of ammo. It can't fight. There is no way the Fed is going to hike rates. It would crash the economy, and it would sink any chance Biden has of getting reelected, if he even has much of a chance to begin with. And the economy is weakening, making it even harder for the Fed to hike rates, because how can it ignore a weakening economy and hike rates anyway? So it's going to dismiss any increase in inflation. In fact, it's already done that this week. It's almost like it's back on its transitory kick, only nobody is going to use the word transitory, but they're basically looking at any hotter than expected inflation data as if it's a one-off thing, as if it's a foregone conclusion that inflation is going back down to 2%, when there's no reason to expect that that's going to happen. Not with record high budget deficits, a record high consumer borrowing and spending, weakening in industrial production, money supply is now growing, and real interest rates are falling. And so all signs point to higher inflation and a weaker economy, and that's the perfect environment for gold. It is stagflation. And as investors lose confidence in the Fed, they're going to look for a real safe haven, a real store of value, and they're going to buy gold. In the meantime, I would suggest those of you who are listening to this video, don't wait for the average investor or even Wall Street to figure this out. Just go and buy. I think you're right near the bottom. I mean, even if you get slightly below 2,000, there is massive support beneath this market. So I think the downside risk is really minimal. I think the upside potential is enormous.
In today's analysis, Peter Schiff provides a comprehensive overview of the current economic landscape, emphasizing the implications of rising inflation and its impact on the price of gold. With inflation numbers exceeding expectations and import-export prices surging, signs point to a bottoming of inflation and a subsequent upward trend. Despite distractions from Bitcoin's rally, Schiff underscores gold's enduring resilience and its role as the ultimate safe haven in times of economic uncertainty. He urges viewers not to overlook this opportune moment, highlighting minimal downside risk and enormous upside potential for gold investors. Don't miss out on these valuable insights. Remember to like, share, and subscribe for more compelling analyses, and share your opinions in the comments section below.